Every income investor wants three things: consistent cash flow, long-term growth, and peace of mind. But can you really get all that in a single ETF? Today, I'm digging deep into SCHD, one of the most popular dividend ETFs on the market, to find out if it truly delivers on that promise. And by the end, I'll show you the one factor that could make or break this ETF for your portfolio, especially if you're planning to live off the income. Hey, I'm Robert, and welcome back to The Alternative Investor. SCHD, the Schwab U.S. Dividend Equity ETF, isn't just a fan favorite, it's quickly becoming the go-to dividend ETF for income-focused investors and early retirees alike. But with more dividend ETFs popping up every year, is SCHD still the best choice in 2025? In this video, we're going to cover everything: its performance, dividend growth, strategy, sector breakdown, how it stacks up against competitors like VYM and DGRO, and one important thing most investors overlook. Stick around, because the last part could seriously impact how you use SCHD in your financial plan. SCHD is short for the Schwab U.S. Dividend Equity ETF. It was launched in 2011 and tracks the Dow Jones U.S. Dividend 100 Index, which includes 100 high-quality U.S. companies that pay consistent, reliable dividends. But this ETF isn't just focused on yield. SCHD applies a rigorous screening process to ensure the companies it holds are financially strong and fundamentally sound. Each company must meet specific criteria such as a solid return on equity, strong free cash flow, and a 5-year history of dividend consistency and growth. In other words, SCHD is designed to focus not just on high-paying dividend stocks, but on dividend payers that are likely to keep paying and growing those dividends in the future. This makes SCHD a smart choice for investors who want both reliability and long-term income growth, all wrapped up in a low-cost package. SCHD currently offers a dividend yield of approximately 3.6%, but what really sets it apart is its impressive dividend growth over time. In the past 5 years, SCHD has grown its annual dividend at an average rate of 11.44%, a pace that outperforms many individual dividend stocks. If you had invested 5 years ago and reinvested your dividends, your income stream would have more than doubled by now. Since its inception, SCHD has never cut its dividend and has delivered consistent growth year after year. In fact, from 2013 to 2024, the annual dividend payout has increased from 88 cents to over $2.70, a total increase of more than 200%. This combination of current yield and high growth makes SCHD a strong option for dividend reinvestment strategies and long-term compounding. SCHD holds a carefully selected group of about 100 companies. These companies are chosen not just for their dividend yields, but for their financial health, profitability, and dividend track records. Some of the largest holdings in SCHD include Broadcom, a major semiconductor company, PepsiCo, one of the most consistent dividend growers in consumer staples, Amgen and Merck, two pharmaceutical powerhouses, and Cisco and Texas Instruments, which brings strong balance sheets and cash flow from the tech sector. The ETF has a relatively tight portfolio for an index fund, and that's intentional. It focuses only on the cream of the crop. In terms of sectors, SCHD leans heavily into industrials, healthcare, technology, and consumer staples. These sectors tend to be more stable and less cyclical than others, which helps SCHD deliver consistent performance, especially during market downturns. Because of its stringent screening, SCHD avoids companies with weak balance sheets or unsustainable payout ratios, meaning you're less likely to run into dividend cuts or poorly managed businesses. SCHD rebalances its holdings once per year. This means that the ETF adjusts its portfolio annually to include only those companies that still meet its high standards for financial performance and dividend sustainability. If a company's financials weaken, for example, if its earnings drop, its debt balloons, or it cuts its dividend, it gets removed from the fund during rebalancing. This allows SCHD to stay focused on high-quality, dividend-paying companies without the need for constant trading. The result is a fund with relatively low turnover and minimal capital gains taxes, which benefits investors in taxable accounts. Because of its focus on quality and its disciplined rebalancing process, SCHD has historically exhibited less volatility than the S&P 500. That makes it particularly attractive for retirees or anyone who wants to generate income without extreme price swings. Let's compare SCHD to two other well-known dividend ETFs. Vanguard's VYM and iShares DGRO VYM, or the Vanguard High Dividend Yield ETF, holds over 450 stocks and focuses primarily on companies that currently pay high dividends. However, VYM's selection criteria are less focused on dividend growth or financial health. As a result, its dividend growth rate has averaged closer to 6 to 7% annually, which is lower than SCHD. DGRO, or the iShares Core Dividend Growth ETF, focuses more on dividend growth but doesn't place as much emphasis on profitability or cash flow. It holds around 400 stocks and includes more growth-oriented names. DGRO typically offers a lower yield than SCHD, usually around 2.3%, but has good potential for long-term appreciation. SCHD sits right in the sweet spot. It delivers higher dividend growth than VYM, stronger fundamentals than DGRO, and maintains a solid yield, all with fewer, higher-quality companies. For many investors, SCHD is strong enough to serve as a core holding, while VYM and DGRO might be better suited as complementary satellite positions. Now here's the part many investors don't talk about. SCHD's dividend payments are not consistent from quarter to quarter. While the annual dividend payout has grown reliably, each quarter's payment can vary significantly. For instance, one quarter might pay out 69 cents, the next 84 cents, then back down to 65 cents, depending on the dividends received from the underlying companies in the fund. If you're reinvesting those dividends, this variability doesn't really matter. But if you're planning to live off the income, it's a factor worth considering. Uneven payouts can make budgeting difficult, especially if you're relying on monthly or quarterly cash flow. Some investors solve this by pairing SCHD with monthly paying ETFs or dividend paying stocks with more predictable payout schedules. Bottom line, SCHD delivers great long-term income growth, but it's not a fixed income product. You'll need to account for some quarterly variability in your financial planning. So, is SCHD still the best ETF for dividend growth in 2025? If you want a fund with a proven track record of dividend increases, an incredibly low expense ratio, a focus on fundamentally strong companies, and a high level of reliability, then yes, SCHD is a top-tier choice. It's not perfect. Its yield isn't the highest, its payments aren't perfectly smooth, and it might not be ideal for every strategy. But for building long-term income and wealth, especially when paired with dividend reinvestment, it's one of the most powerful ETFs on the market today. I'm Robert, and this is The Alternative Investor. If you found this breakdown helpful, give the video a like, and subscribe for more content like this, and drop a comment. Do you hold SCHD, or do you prefer another ETF for dividend growth? Let's compare notes.